In this week's edition of The Numbers Are Made Up and the Points Don't Matter. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of October 3rd, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. We did it, we made it through the month. September is over, and now we're gonna see if we get some blue October skies and new highs, or if we're gonna continue the hunt for red October. Don't really know what's gonna happen this month. There's a lot of bad macroeconomic events on the horizon, starting with the September jobs report coming out at the end of this week. We've got some announcements coming out of the Fed. We've got the potential failure to raise the debt ceiling, even though I doubt that's actually going to happen. And we've got the fact that inflation seems to be here to stay. And all of Jerome Powell's mentions about inflation being transitory, well, they were transitory in and of themselves, because now he's moving on saying inflation is here to stay for a bit. I was trying to get another research video out for you guys last week, but there was something that I was missing from the SEC filings, and my research team had a tough time finding the information. I'm the research team. I'm a one-man operation. So I'm going to continue looking for that through the SEC filings this week so I could get that video out to you guys next week. Like I said last week, it wasn't very time sensitive, so not much has changed. I just really need to find some information about one of the inside buyers. And the SEC Edgar website, all of the SEC filings, I don't know what they have against just freaking double spacing their documents. Like, I can increase the text size on the pages, but geez, they're so hard to read without the double spacing. Anyway, old person complaint. Let's get started with the news. This is right after market close on Friday. Stock market news live updates. Stocks rebound after September slump. Dow posts best start to October since '03. Stocks advanced on Friday with equities recovering some of the losses after closing out a volatile month in the red. The Dow outperformed compared to the other two major indices. The S&P also gained, adding about 1.2% as cyclical stocks led the way higher. That's really interesting. The session also marked the blue chip index's best start to an October since '07. NASDAQ rose by 0.9% and Russell rose by nearly 2%. The S&P ended a 7-month winning streak in September, posting about a 4.8% monthly decline. The Dow ended September lower by 4.4%. The NASDAQ underperformed, shedding 5.4% amid a broad rotation away from growth and tech as expectations for inflation and higher rates took hold. Now, the fact that cyclicals were leading the way for the S&P's recovery on Friday was a little bit shocking to me, because you would think with all of the negative macroeconomic news that cyclicals would be kind of depressed a little bit, as there's kind of a fearful air in the market still yet. Cyclicals typically rise as interest rates fall, and interest rates aren't really falling, nor are they bound to rise anytime soon, but also cyclicals are very sentiment driven, and the fact that they're rising makes me believe that the market makers, the smart money, believes that people are going to be spending their money. Perhaps this is the beginning of the holiday season surge. I suppose that's one possibility here, but I was just really surprised to see cyclicals leading the way. I thought maybe it would be something like consumer staples leading the way, or industrials, or like kind of blue chip dividends, that type of thing. But really, that was very surprising to me. It was a pleasant surprise, but it was a surprise nonetheless. Also, the S&P ended up declining about 4.8% in September. That's almost a 5% decline in a month, which is almost correction territory. Usually that 5% is kind of the benchmark for a correction. So we didn't quite make it there, and it happened over the course of an entire month, so it wasn't really all that extreme. But, you know, when in doubt, zoom out. We're still up 15% year to date, even with that 5% drop in September. It was just a rough month, but we are heading into the big retail spending season all around the world, so I think everything's going to get a little better. September wasn't as bad as I thought it would be. I don't think we're out of the woods yet, but it's looking up. Now, one of the stocks that I thought would be actually doing quite well with the market dropping was Cleveland-Cliffs. You guys know I talk about Cleveland-Cliffs a lot on this channel, and this was posted on Friday on Barron's 5 stocks to play the steel industry's revival. And the author ends up running a financial comparison of 5 different companies: Cleveland-Cliffs, Nucor, Steel Dynamics, Stelco Holdings, and US Steel. And he says that investors are overlooking several positives. The growth in US steel demand is likely to average 3 to 4% annually in coming years. North American auto production could increase next year as chip shortages ease. More infrastructure spending and the build out of renewable sources of electricity, especially steel-intensive wind turbines and related transmission lines, all bode well. And And this is something that a lot of people miss. US steelmakers are currently the cleanest in the world because 70% of domestic production comes from lower emission mini mills that use scrap. Steel's green tint may solidify political support for current tariffs of 25% on many imports, which account for about 20% of the market. The whole premise here is that the less US companies, US builders import foreign steel, the better it is for US steel producers. And that comes with or without the steel infrastructure bill, without the infrastructure bill. The infrastructure bill, don't get me wrong, would be absolutely huge, but we don't have it yet. And this steel thesis isn't really dependent on that. And if we look at things that are happening around the globe, just look at the numbers coming out of China. China's steel exports in the last week tanked. China is keeping all of its steel internally, and they're putting their own import tariffs in place on companies bringing in foreign steel to stimulate them to purchase Chinese steel for Chinese development. So China is becoming really, really insular with the steel situation, and American demand for steel is incredibly high. And I didn't even think about the automotive aspect. Like, I've talked about the semiconductor shortage, but I didn't even really consider the impact that the semiconductor shortage was having on the steel market with the bottleneck for new car manufacturing. Let's take a look at Cliff's chart. Cleveland Cliffs had been absolutely flying upward in July. We ended up hitting a high of about 26.51 in the middle of August after rising for an entire month from the middle of July. But since then, we've really dropped off hard. Right now, we're sitting at 1966, 1975 after close. If you look at the uptrend channel, this actually broke out of the channel to the downside. So I'm not really sure what to call for the price action here, but I do know that the general market dynamics for steel are very positive. Also, in Cleveland Cliffs' favor, they're only trading at a PE of 3.35. Cleveland Cliffs, keep in mind, is going to be debt-free by 2022. So you're sitting at a company that's debt-free in a high-demand field in an environment where steel is going to be even more important and China is not going to be exporting its own steel. And you're looking at this, and this just is such an incredible investment opportunity. As my catalysts hit for my biotech stocks and I rotate out of them, I'm really going to be rotating almost everything into Cleveland Cliffs over the next couple of months because I am so bullish for it going into 2022. Now, another one of those consumer cyclical companies, Ford, this news came out on September 27th. The headline is a little bit misleading. I'll talk about that in a moment. Ford to lead America's shift to EVs with a new mega campus in Tennessee and twin battery plants in Kentucky with an $11.4 billion investment to create 11,000 jobs and power a new lineup of advanced EVs. They're going to call this the Blue Oval City, and the complex will be constructed on nearly 6 square miles in West Tennessee. They'll be building the next generation electric F-Series pickups and advanced batteries there. The new Blue Oval SK Battery Park is going to be built in central Kentucky, and it's going to consist of twin battery plants that'll power a new lineup of Ford and Lincoln EVs. One of the things that I liked about this, and I actually saw this in the news here in Korea, Ford and SK Innovation plan to invest $11.4 billion, and the production will begin in 2025. SK Innovation is, of course, one of the leading battery manufacturers, mostly just a chemical company here in Korea. So their partnership with Ford is something that I do see popping up in the newspapers here. And this announcement, I actually missed it on the American news first, and I saw it on the Korean news here. So I was really happy when I saw that, when I saw the Ford logo on the news and I heard the anchors talking about it. This was something that I was pretty excited about, and I am a Ford investor, and I know their float is ridiculous. Their shares outstanding is ridiculous, and they've just been kind of swimming in place for a long time, but these are steps in the right direction. The problem that I have with this article is the title. It is so sensationalist. Ford is going to lead the EV market. No, not really. Tesla has a huge advantage on Ford, and even though Ford has the best-selling pickup, the best-selling car in America, the F-150, going into EV, Tesla still has an edge there, and also GM is a Goliath already. GM has been selling full EV autos in America for a really long time, and GM's very well developed on this way. So if anything, when you look at this amount of money that Ford can dump into this plant, and you consider how far ahead Tesla and GM are, I think the one big takeaway here is look at all of these smaller EV startups. Look at the SPACs. Look at the companies that are coming into the scene like Canoo, like Lucid, like Lordstown. Sorry, I couldn't help myself. But if you look at these other companies, like how can they be expected to compete with Tesla, GM, and Ford? Even if we just look at the total market value, and by the way, this chart is absolutely absurd. We have the total market value in US dollars of Tesla up here, coming in at 700 billion. Toyota's at about 200 billion. VW's at about 100 billion. Other than Tesla, these aren't really US brands until we get down to GM at 65 billion. Ford's not on this list, but it is just under Ferrari. Ford's at about 55 billion, so it just missed the cut on this list. This looks like a top 10. But you can see the amount of money that these companies have in market value and market cap. You can see the amount of capital that they can attract with foreign investors, with SK Innovation partnering with Ford to spend 11 billion on this plant. And it really just, it kind of makes you wonder how much of a good investment some of these new EV companies are. If we take a look at Ford's stock after the news, there was a little bit of a rise on Monday, followed by kind of a drop off this week. Ford stayed pretty flat when the rest of the market was rising. Ford also, it's really tough to move the stock price here. Ford has almost 4 billion shares outstanding, and Ford recently cut its dividend, and it was a dividend stock, a dividend king for a long time, but now its dividend is nothing. That was cut at the start of the COVID pandemic. So there's not really a lot of reason for a lot of investors to invest in Ford right now. So it takes a lot to move the stock price. I think Ford's really not going to be moving much until the dividend comes back, and that pulls people coming back in for one big surge. It has performed well since the COVID drop, going down to a low of about 396, but, you know, we've been flatlining here for the last couple of months. Next news story, and I promise this is actually an investing story. McDonald's McRib is back to McTantalize your McTaste buds. It's my McFavorite time of the McYear. The McRib is back, and I get to savor the flavors of purely processed pork and pickles on a bun. It's that time of year. The McDonald's McRib is circling back to the menu just in time for its 40th anniversary. The fan fave, a sub-sal sandwich, pork topped with barbecue sauce, onions, and dill pickles, is returning on November 1st for a limited run. Now, you may be asking why I'm even talking about this. This seems like such a trivial thing. I don't really talk about McDonald's that much on this channel. Well, there's actually a really interesting correlation here. Well, I guess two really interesting correlations for McDonald's. They bring out the McRib after consecutive months of decline in pork prices. You can basically know what's happening with the pork price market, the pork futures, just by understanding if the McDonald's McRib is on the menu or not. This is a really cool correlation. This is a study, I think it was on Business Insider. It was published back in like 2011, and it was looking at the correlations of pork prices to the release dates of the McRib. And you could see consecutive months of decline, McRib comes out. Consecutive months of decline, McRib comes out. Consecutive months of decline, McRib comes out. Same thing, same thing. And something even further, there's almost like evidence of a double top, 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 right before every single McRib release. You can kind of see where the pork prices are when you look at the McRib being on the McDonald's menu or not. And if we look at the pork futures right now, lean hog futures for the end of day settlement price, again, we just had reached a high point in June, and we've seen a couple months of consecutive decline. Worth noting, there really isn't a double top here, and we are still pretty high for the pork prices, but here we go. Look at where the pork prices were for years and years and years. They were really kind of just in this range between about 86 and maybe a low of about 45. That's a really big range, but we are outside of that range right now with the prices around $92. So this makes me think that McRib is not going to be in the stores for a very long time at all this time. Historically, McRib is what's called a loss leader at McDonald's, and a loss leader is an item that a retailer is going to sell to bring customers in and spend money on other items, and the retailer knows that they're going to be losing money on this item. And this kind of fits with the theme with McDonald's waiting for the pork futures prices to pull back before bringing the McRib out, because they know it's going to be a loss leader, so they're trying to cut their losses as much as possible while still generating that excitement, you know, that once a year excitement for bringing the McRib out and pulling people into the stores. And it goes even further than that. And this was an article that was released on Of Dollars and Data back in 2018, did a really cool analysis here that showed a correlation that the S&P 500 has a higher daily return when the McRib is available. So the average daily return of the S&P 500 with the McRib versus without the McRib. With the McRib, we're gaining about 0.1% per day. Without the McRib, we're only gaining about 0.03%. If we go back to that first chart I showed you, you could see the McRibs come out in October. Guess what month we're starting? October. I don't actually believe that that, there's any causation here. I think there's a correlation, of course, with the McRib coming out and the S&P performing well in October. I think it's because it's heading into the spending season, the holiday season. Money starts flowing in, and I really think that's all there is to this, but it's still quite an interesting correlation to note. Couple conclusions you could draw. If you see the McRib on the menu, pork prices are down, and the S&P is going to be doing pretty well. Take a look at the McDonald stock. With the McRib announcement, absolutely no movement. We have negative movement on the McRib announcement. That's not enough to move the stock price. McDonald's stock is such a slow burn, too. Our price right now is about the same as the high was back September a year ago. So the stock price for McDonald's really hasn't even moved much in the last year. People who are buying into McDonald's, though, they're looking for something consistent. We've got a 2.27% dividend, and it's not like McDonald's is going to fail overnight. So it's a very safe place to park your money, but it's not exactly an explosive growth company. This is a very mature company. Next news story, this one made the rounds, but I think Coinbase got blamed a little unfairly here. Coinbase discloses a major hack. Over 6,000 Coinbase accounts were hacked between March and May 20th of 2021. On Sunday the 24th, Coinbase disclosed the hack to the California Department of Justice. The disclosure states that between March and May, bad actors hacked the accounts of as many as 6,000 customers via a vulnerability in SMS multi-factor authentication. Coinbase claims that in order to access these accounts, these hackers gained access to the email addresses, passwords, and phone numbers associated with Coinbase accounts. Coinbase states that they're unable to determine exactly how the hackers managed to access this information, but that it's typically done via phishing or social engineering techniques. But here's the cool part. We will be depositing funds into your account equal to the value of the currency improperly removed from your account at the time of the incident. Some customers have already been reimbursed. We will ensure all customers affected receive the full value of what you lost. So the headlines, not necessarily this one, but some of the other ones that were covering the story were basically implicating Coinbase as the guilty party in the hack here. But these were all 2FA accounts that were hacked, and in order to do that, the hacker had to actually get access to the email addresses of the people that were involved. So it's not necessarily that the Coinbase accounts were hacked, rather email addresses were hacked, and then that information was used to just log in to the Coinbase accounts and steal the money. I really hate that Coinbase is getting blamed with this one, but I think it's really awesome that they're reimbursing the accounts of the people that were hacked. I mean, it is only 6,000 accounts, but I think it's a really great PR move, and it's kind of their way to combat unfair blame that's being shifted onto them. Also, the fact that it's 2021 and we still have people falling for phishing scams and social engineering scams, like, this is ridiculous. Come on, people. Man, that Coinbase chart is a wild one. This was the IPO day. Remember when it ended up shooting up to 429? And since then, we've just been dropping. Coinbase is down at about 231, and I think at this point, we can't really shake out any more investors at Coinbase. There's a really strong floor here right around 215. We've touched 215 about 3 times now. We've only gone below it once. So 215 seems to be a pretty strong floor for Coinbase, a strong line of support, but this chart is so ugly. The financials of the company, they're increasing every quarter from 300 million to 600 million to 1.8 billion to 2.23 billion. Net income ended up dropping off. They ended up having to pay out some money for a special tax, but that was kind of a one-time thing. I think Coinbase is going to be fine in the long run. It's really kind of separated itself from Bitcoin a little bit, which is nice to see. All right, a couple of notes about some macroeconomic situations, and I know these are really dry and boring, and I don't want to kind of kill your time with it, so let's go through these quickly. Fed Chair Powell to warn Congress that inflation pressures could last longer than expected. The remarks are part of the mandated testimony Powell must give to Congress regarding the Fed's economic response to COVID. Economic growth has continued to strengthen, but it has been met with upward price pressures caused by supply chain bottlenecks and other factors. We've seen this again and again. These effects have been larger and longer lasting than anticipated, but they will abate, and as they do, inflation is expected to drop back toward our longer run 2% goal. I don't really know what weight to put in Powell's words right now, and the market at this point just isn't even reacting to anything he says. The writing was on the wall that inflation was more than transitory all summer when we looked at materials prices, when we looked at shipping costs, when we looked at producer costs were rising, so obviously consumer costs were going to rise. We could see that inflation was more than transitory, and yet Powell came on every week and said inflation is transitory. Now, finally, he's saying what we all know, that it's here to stay, at least for a little bit. I think the market's just been inundated with Powell quotes, and whatever he says really isn't going to carry any weight anymore until we hear something about the Fed increasing interest rates. More news coming out of the Fed. I covered this story a couple weeks back. Dallas Fed President Kaplan is going to retire early on October 8th, citing trading disclosure distraction. Oh, a distraction. What a fun word to say when you mean I did something that was entirely ethically inappropriate and I got caught for it and now I'm being forced to retire. Dallas Fed President said on Monday he's stepping down following the controversy over his stock holdings. Boston Fed President Eric Rosengren, who had come under similar scrutiny, announced earlier in the day that he was retiring. Oh no, we're losing Kaplan and Rosengren because they did something that was morally questionable. The Federal Reserve is approaching a critical point in our economic recovery as it deliberates the future path of monetary policy. Unfortunately, the recent focus on my financial disclosure risks becoming a distraction to the Federal Reserve's execution of that vital work. Oh, how noble. Well done, good sir. Kaplan insisted he had done nothing wrong. During my tenure, I have adhered to all Federal Reserve ethical standards and policies. My securities investing activities and disclosures met bank compliance rules and standards. Less than a week after there was an ethics committee created to investigate the situation, the president's just retired. So rather than facing the scrutiny of the investigation, they just stepped away. I mean, it's not like they're stepping away and they're retiring into a life of poverty. Man, I am just sick of seeing politicians and leaders of banks and all of these insiders making money like this. It is so unfair that they know a policy change is coming and they're allowed to execute trades before the general public can execute those trades. I feel like people don't get into politics or they don't get into these leadership positions. I know Federal Reserve's not technically politics, but you guys know what I'm saying. I feel like people get into these positions to get rich, to have that insider information. There was a really cool op-ed that was written this week. This was on Bloomberg Opinion. It was published by Mark Gilberg on October 1st. Redditors are right about the unfairness of the market. It's been a bad week for capitalism with corporate insiders, judges, and policymakers all playing fast and loose with the rules about personal investments. I couldn't load the full text, but I did find it on Reddit. It was posted in Stocks if you guys want to see it. Daniel Taylor, a professor at the Wharton School of Business, has amassed evidence of widespread insider trading by company executives. An investigation by the Wall Street Journal found that more than 130 U.S. federal judges failed to recuse themselves from 685 court cases involving companies in which they or their families had investments. And at the Federal Reserve, 2 policymakers have resigned, Kaplan and Rosenberg. Now, this isn't really shocking. We know this is happening, but I'm so glad this is getting more publicity at the forefront. Now, of course, this was brought to our attention years ago with the Panama Papers, which everybody seems to have forgotten about. But moving on from that, I'm so glad that large outlets like the Wall Street Journal, like Bloomberg, are picking this up and running with it. Now, I wish Bloomberg would not just put this in an op-ed, but would actually start running some real stories on this. And moving on, in this week's edition of The Numbers Are Made Up and the Points Don't Matter, the U.S. economy grew a revised 6.7% in the second quarter, GDP shows. Employment numbers are down, inflation is up. Does it feel like the economy is growing to anybody? No? Yeah, me neither. The US got a big jolt in the spring from government stimulus payments and coronavirus vaccines, allowing businesses to reopen. The government's third estimate of GDP for the quarter was largely in line with its prior analysis. The rise in consumer spending was slightly faster at 12%, and exports were revised to show a 7.6% increase instead of a 6.6% increase. I don't really think this means anything. The inflation numbers seem to not matter. The GDP numbers seem to not matter. I don't really know what figures to look at to see the health of an economy when debt is just mounting and international trade is being stymied because of shipping bottlenecks and supply chain issues. So I think this means absolutely nothing. Another big story this week, there is a debt ceiling issue. Lawmakers are again debating whether to increase the debt ceiling, the amount of money the US government can borrow to pay its bills, for the 88th time since 1959. 88 raises of the debt ceiling since 1959. That's the sign of a healthy economy too, isn't it? For decades, Congress has limited how much the federal government can borrow to meet its financial obligations, thank God. The cap is now at $28.4 trillion, with the national debt at $28.43 trillion. We've got more debt than the cap, so we have to raise the cap, otherwise we're risking defaulting. It would be near impossible for the US to meet its financial obligations, including payments to veterans, Medicaid, Social Security recipients, without suspending or raising the debt limit by October 18th. This is our deadline. Federal workers' salaries would also be delayed in the wake of a default. And Moody's Analytics called a potential default a catastrophic blow to the nascent economic recovery from the COVID-19 pandemic, adding Americans would pay for this default for generations. My take on this, the US has never defaulted. The US will never default. The debt ceiling will be raised in time before the deadline, and we're going to move on. I think this is just sensational headlines being pushed by the news for, reasons, because fear sells and people are more interested in seeing stuff like this. So this entire debt ceiling situation to me means nothing. Just like the GDP numbers. It's amazing how a lot of these numbers just feel really fake to me right now. Let's take a look at the upcoming earnings for this week. Now, I'm recording this video on a Saturday, so I don't have my typical earnings whisperer graphic. We'll just go through quickly on the NASDAQ website. Not many huge market cap companies reporting this week. China Petroleum and Chemical, it's a state-owned company, so I'm not really going to be looking at that. Duckhorn portfolio is kind of interesting. They started being traded a couple quarters ago. They get traded under the ticker Napa, and it's basically a wine distributor. So that's one, I guess, that's kind of interesting. It's the second largest company reporting on Monday. On Tuesday, we have PepsiCo reporting with a $210 billion market cap. This is a big one. The more I see about this company, the more I think Pepsi is a much better investment than Coca-Cola at this point because of their diversification into snacks and their business partnerships. Wednesday, we have Constellation Brands, which is another beverage distributor, beer distributor, malt beverage distributor. We've got Levi's, RPM International, Acuity. Again, these aren't like really huge companies that are reporting, nothing too exciting. I mean, I guess 3 beverage companies in a row reporting Monday, Tuesday, Wednesday with Duckhorn, PepsiCo, and Constellation is kind of cool. That way we can see if people are still drinking things other than water, I guess. There's no conclusion here, I don't know. Thursday, we have Conagra and Lamb Weston and Tilray. I know a lot of people are really going to care about Tilray, but I'm not really too big on Tilray right now. Lamb Weston and Conagra are very interesting. Conagra is going to be a consumer staple, and same thing with Lamb Weston, consumer staple. I found something really, really cool about Lamb Weston online. So this was an article I found about Lamb Weston. Just 2 stocks in the S&P 500, consumer staples Lamb Weston and financial market access holdings, have topped the index in each of the past 3 fall seasons. Now, I'm not making like a big generalization about this because the fall season, 3 months, it's only 3 months, it's a small window, but the fact that Lamb Weston especially has beaten the index for 3 straight falls in a row, that's pretty interesting. And I don't think it's going to continue this year for a couple of reasons that I'm about to show you. I think this is the year where the Lamb Weston train stops. Now, before we get into those reasons, I want to just look at the chart for Lamb Weston. So this was on the COVID drop. We went down as low as 39. We ended up going up, and since the end of July, we've been dropping off. So currently, we're sitting at about 62.80. So you could see from about $40 to 62.80. We're up 50% from the COVID drop, but we gave up those really big highs that we had, and we still haven't reached the $96 high right before COVID. So what's going on? Let's take a look at the financials. So revenue has been increasing, 871 million, 896, 895, 1 billion. And if we go back, we can't find another $1 billion quarter until right before COVID at 1.02 billion. But if we look at the net income on that quarter before COVID, it was 125 million. So they were making 125 million, about 12% on 1 billion in revenue. But right now on the last quarter for 1 billion, their net income has gone in half. It's about $56 million. So when you wonder, like, why hasn't the price recovered even though the revenues have recovered, their net income is about halved since where it was last time the revenue's been at this point. And there's a lot of reasons for this, including the supply chain bottleneck, but also increased costs for things that producers need to grow potatoes, and potatoes are the primary item that Lamb Weston sells. They sell frozen potatoes. Part of that is that we have very high fertilizer prices right now, and near record high fertilizer prices are further projected for 2022. This is coming in with both ammonia or nitrogen-based fertilizers and potassium-based fertilizers. And I looked up the best fertilizers to grow potatoes, and guess what? Number 1 is a nitrogen-based fertilizer, and number 3 is a potassium-based fertilizer. Ruh-roh. So we already have fertilizer prices that are very elevated, and we're heading into a year where fertilizer prices are further projected to hit record highs. So we've got thin margins for Lamb Weston right now. There are supply chain bottlenecks with transportation. We see that in all different types of industries, and fertilizer prices to grow the actual potatoes are high. I'm pretty sure this is the year where Lamb Weston fails to beat the S&P 500. Now, am I saying it's not going to have a good quarter? I wouldn't really go that far, but I definitely believe that it's going to be underperforming the S&P 500 for the first time in 4 years this year, and those are my reasons why. All right, everybody, that's it for me today. I hope you did enjoy the video. I will be hitting you this week with at least one more research video once my research team, me, ends up finding something on the SEC filings that I needed to find. So if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe, happy investing, and I'll see you next time.